A house priced at 3.4 million dropped to 1.7 million yuan. The contract was signed this afternoon. Already received a deposit of 20,000 yuan, feeling anxious about the loss, unable to recover from the shock for a long time. In Nanning, many houses are struggling to sell, such as old and small ones, and those in the remote suburbs. The number of houses being listed for sale increased daily, and the time to close deals is getting longer. Some second-hand houses have been on the market for 2 to 3 years without finding buyers. Most properties have lost their financial attributes and liquidity, let alone any investment value. Therefore, new houses are selling even cheaper than second-hand ones. As Chinese property price plummet significantly, real estate companies are collapsing one after another. Firms like Yango Group, Tahoe Group, Sundy Group, and Oceanwide Holdings have been delisted. Later, two of China's long-standing real estate giants listed on the A-share market, Shanghai Shimao Property Holdings Limited, with the stock name of ST Shimao, and Jiangsu Zhongnan Construction Group Co-Limited, known as ST Zhongnan, are now facing delisting. In Chinese stocks, ST stands for special treatment or special treatment stock. It indicates that the company has encountered financial or operational issues that could pose risk to investors. Despite efforts such as executives increasing their shareholdings and selling assets to shore up their positions, these companies ultimately failed to reverse their fortunes. On the evening of May 15, ST Shimao announced that it had received a preliminary notice from the Shanghai Stock Exchange regarding the termination of its stock listing. The notice indicated that from April 12 to May 15, 2024, the closing price of ST Shimao stock had remained below 1 yuan for 20 consecutive trading days. According to relevant regulations, the company's stock had triggered the conditions for delisting. The Shanghai Stock Exchange will make a decision to delist the company's stock in accordance with relevant regulations. According to the rules of stock listing rules, trading in ST Shimao's stock will be suspended from the opening of the market on May 16, 2024. The closing price on May 15 was fixed at 0.43 yuan, with a total market value of about 1.6 billion yuan. Meanwhile, the Shanghai Stock Exchange, or SSE, will convene the listing committee within 15 trading days after the expiration of the company's deadline for submitting hearings, statements, and defenses. Subsequently, based on the deliberation of the listing committee, a decision will be made on whether to terminate the listing of the company's stock. Following this, within 5 trading days after the SSE announces its decision to delist the company's stock, the stock will be delisted, marking the termination of the company's stock listing. Following the footsteps of Tahoe and Yango, Shimao becomes the third Fujian-based real estate company and the first to lock in A-share delisting this year. According to Wind, as of the end of first quarter, Shimao has about 36,700 shareholders. For ST Shimao, this final delisting date will arrive in early June, signaling the end of over 30 years of its listing journey. Shimao Group is a comprehensive real estate listed company under Shimao Group, engaged in the development, sales, business operations, management, and diversified investment of comprehensive real estate properties. It was established in July 1992 and listed in February 1994, marking over 30 years. Shimao Group is one of the few real estate companies that have achieved a dual listing platform on both A and H shares. During its peak, Shimao Group was among the top 10 in the industry. Chinese media reported that before 2019, Shimao Group was renowned for its stability. Its chairman, Xu Rongmao, was recognized as the godfather of luxury homes, with about 1/3 of luxury projects in Beijing and Shenzhen. But his son, Xu Xitan, did not adhere to the conservative style. Upon taking over, he immediately acquired projects from multiple real estate companies such as Tahoe Group and Van Tone Real Estate. He even acted as a white knight to save the Fushen Group. The result was debt totaling hundreds of billions. A 74-year-old native of Guangzhou, Fujian province, Mr. Xu Rongmao comes from a family of traditional Chinese medicine practitioners. He moved to Hong Kong in his early years. It is said that he initially worked as a broker in a security firm. In 1981, he founded a financial company engaged in investment business. He was said to have earned 500 million through stock trading, although he later denied this figure. Soon after, he returned to the mainland and made significant investments in the textile industry. He purchased 6,000 acres of land in his hometown of Fujian with plans to enter the real estate industry. But following the events of Tiananmen Square massacre on June 4, 1989, he immigrated to Australia with his family. 2 years later, he observed that the environment was stabilizing, especially with real estate boom in Hainan. He saw it as a good opportunity to make substantial profits, thus deciding to return to the mainland. Upon returning to Fujian, he found that the land he had previously purchased had appreciated by 50%. That prompted him to once again venture into real estate industry. In 1993, he invested 200 million yuan to acquire 500 acres of land in Wuyi Mountain. But by 1994, the real estate industry faced its first round of regulations that tightened credit and significantly reduced investment scale. Despite the widespread concerns about the situation, Mr. Xu chose to go against the tide. At the time, land prices in Beijing reached as high as 2,000 yuan per square meter. Despite this, Mr. Xu invested over 4 billion yuan to develop multiple real estate projects. These include the 100,000 square meter Asian Games Garden, the 200,000 square meter Huao Center, Scenic Garden, and the 60,000 square meter Purple Bamboo Park. He focused on enhancing the quality of the properties, resulting in excellent sales of these projects. After 5 years of effort, Xu Rongmao made substantial profits from his real estate projects in Beijing, but chose to abandon the capital and turn to Shanghai. His reason was simple. Compared to Beijing, Shanghai has a market with more potential. After the company relocated to Shanghai in 1999, Xu Rongmao embarked on projects such as Shimao Square, Shimao Riviera Garden, and Intercontinental Shanghai, fully enjoying the dividends of the real estate industry. With the continuous growth of the family fortune, Mr. Xu has consistently ranked among the top few of the rich list for many years, even briefly becoming the richest man in Shanghai. At the same time, Shimao has also become a billion-dollar real estate enterprise. Chinese media articles mention that Xu Rongmao has a daughter and a son. His daughter once assisted him in managing the company and performed well, but she unexpectedly resigned shortly afterward. It turned out that according to Xu's family tradition, successions must be passed on to the son. Therefore, even if the daughter performed exceptionally well, she had to step aside. As for his son, Mr. Xu had high expectations. When Xu first entered the industry, Xu Shitan was still in his teens. The name of the company, Shimao, was derived from a character in both his and his son's name. Mr. Xu invested a great deal of effort in cultivating his son. He insisted that his son start from the grassroots level after graduating from university, working in real estate sales and making hundreds of phone calls every day. A year later, Mr. Xu entrusted his then 23-year-old son with the most upscale property in Shanghai at that time, Shimao Riviera Garden, for practice. This project was highly successful, as Shimao Riviera Garden remained the top-selling property in Shanghai for the following 4 years. As a result, Mr. Xu promoted his son to the position of director and vice chairman of the group. To nurture his son, Mr. Xu demonstrated tremendous patience and effort over a span of 20 years. He not only guided his son on how to improve products and enhance sale performance, but also recruited talents from other companies to support his son's work. When Xu Shitan finally took the helm of the family business, he had his own plans and style. His strategy was grandiose, encompassing real estate, hotels, property management, as well as high-tech, medical, elderly care, and financial sectors, aiming for higher, faster, and stronger outcomes. In 2019, he shocked the entire real estate industry by investing 20 billion yuan in over 20 projects within just 80 days, doubling Shimao's land reserves. Subsequent to the pandemic, coupled with the Chinese government's tightening regulations on the real estate sector, the company's liabilities soared rapidly, while sales did not meet expectations. In 2022, the company plunged into a bankruptcy crisis and the value of its listed stocks plummeted. To address this crisis, Xu Rongmao even had to sell his own luxury homes, but ultimately he could not salvage the situation. The bankruptcy liquidation of Shimao Group became an inevitable outcome, and Xu Rongmao's assets accumulated over 4 decades became difficult to preserve. Mainland media reported that since officially declaring default in July 2022, ST Shimao has been deeply mired in debt. Financial reports show that the company incurred a net loss of about 9 billion yuan in 2023 and 64.5 million yuan in the first quarter of 2024. As of April 30th, ST Shimao and its subsidiaries have accumulated a total of 12 billion yuan in outstanding debts to public market creditors, banks, and non-bank financial institutions. On May 8th, ST Shimao announced that the 6.1 billion yuan principal and interest of the second tranche of the medium-term notes due to 2021 should have been repaid on May 6, 2024, but this payment was not made on time. As of the announcement date, the total principal and interest of public market debts of the company and its subsidiaries amounted to 4.4 billion yuan outstanding. ST Zhongnan took an earlier step in securing its delisting fate. On the evening of May 13th, ST Zhongnan announced that it had received a pre-notification letter from the Shenzhen Stock Exchange. Due to the company's stock value below 1 yuan for 20 consecutive trading days from April 3rd to May 8th, it triggered the conditions for delisting according to the stock exchange listing rules. The Shenzhen Stock Exchange intended to terminate the company's stock trading. Meanwhile, on May 8th, ST Zhongnan closed at 0.56 yuan per share, marking its final closing price. As of April 30th, the number of shareholders of ST Zhongnan was about 113,500. Established in 1985, Zhongnan Construction has been listed on the Shenzhen Stock Exchange since 2009, totaling 15 years of trading. The company is the largest real estate enterprise in Nantong City. In 2020, Zhongnan Construction reached its performance peak, announcing a contract sale amount exceeding 220 billion yuan. According to the 2020 annual report, the company achieved operating income of 78.6 billion yuan, a year-on-year increase of 9.4%. The net profit attributable to shareholders was about 7 billion yuan, a year-on-year increase of 70%. The company's founder and actual controller, Chen Jingxi, became the richest person in Nantong that year with a fortune of 40 billion yuan. In recent years, with the downturn in real estate industry, Zhongnan Construction's performance has plummeted dramatically. The company reported losses of about 3.4 billion yuan in 2021, 9.2 billion yuan in 2022, and 5.3 billion yuan in 2023. In the first quarter of 2024, the company continued to incur losses of 600 million yuan. Over the past 3 years and the first quarter, the company has had a total loss of about 18.5 billion yuan. Chinese media reported that ST Zhongnan had actively taken a series of measures to rescue itself. As early as February, Zhongnan Construction announced a notice of partial directors and executive voluntarily share increase. This includes 6 directors and executives, including Shi Jinghua, planning to increase their holdings by 5 to 10 million shares through the secondary market within 6 months, starting from February 8th. As of May 8th, related personnel had increased their holdings by about 6.8 million shares, accounting for 0.18% of the company's total, with an increase of about 4.8 million yuan. ST Zhongnan originally hoped to boost investors' confidence in stock price through executive share increases, but during the sensitive period after the release of the annual report and the first quarter report, the executives failed to implement the share increase, resulting in another decline in the stock price, ultimately leading to the possibility of delisting. In addition to the self-rescue plan, ST Zhongnan also attempted to introduce strategic investment to escape the delisting crisis. On April 20th, led by the government of Haimen District, Nantong City, the controlling shareholder of Zhongnan Construction, Zhongnan City Construction, began negotiations with Asia's renowned private equity investment company, PAG, and Jiangsu Assets on debt resolution and equity transaction. On April 22nd, the Shenzhen Stock Exchange issued an inquiry letter to Zhongnan Construction requesting the company to disclose the true situation of its cooperation with PAG and other information. Perhaps influenced by this news, Zhongnan Construction stock soared to the limit up on the same day's opening, closing at 0.84 yuan per share. That evening, Zhongnan Construction issued a third announcement indicating the possibility of facing delisting. Soon, Zhongnan Construction released its 2023 annual report showing a loss of 5.3 billion yuan for the year, marking the third consecutive year of loss. On April 23rd, Zhongnan Construction halted trading for one day. When it resumed trading on April 24th, it hit the limit down and was subjected to other risk warnings, with its stock abbreviation changed from Zhongnan Construction to ST Zhongnan. Afterward, the stock price of ST Zhongnan began to plummet. On May 8th, when trading opened, the stock price of ST Zhongnan remained at 0.56 yuan per share, with a total market value of only 2.14 billion yuan. Zhongnan Construction had to face the fate of delisting. According to the incomplete statistics of Zhongfan.com, since 2023, a total of 12 real estate enterprises have been delisted from both A shares and H shares. Among them, 8 A share enterprises including ST Yango, ST Tahoe, ST Calzon, ST Sundy, ST Yuetai, ST Meizing, ST Zhongtian, and ST Langguang were delisted due to the closing price being below 1 yuan for 20 consecutive trading days. 4 H-share enterprises, including Shanshan Holdings, Carnival Group, International Holdings, Nanhai Corporation Limited, and Cynic Holdings, were delisted due to the main board company's securities being suspended for 18 consecutive months and failing to complete the resumption guide on time. Among these delisted real estate enterprises, there were once billion-dollar enterprises such as Cynic Holdings, Langguang Development, Sundy Group, and Tahoe Group. In addition, more real estate enterprises are also teetering on the brink of delisting. It is understood that among the current Hong Kong listed real estate enterprises, many have been suspended from trading since March or April last year. They include Jiaoyuan International, Datang Corporation, Redco Group, Huijing Holdings, Xinmen China, Xingshan Hold Group, SRE Group, and Dafa Properties. In March, due to the delayed release of annual performance report, many real estate enterprises including Country Garden, Sunquan Properties, Ida China, Modern Land, Rongshine China, Dexing China, Zhensun Enterprises, and Everreach Group announced suspensions. The Chinese real estate industry continues to languish, and billion-dollar real estate enterprises are collectively disappearing. According to statistics from the Reihe think tank, as of 2023, only 11 real estate enterprises have annual revenue exceeding 100 billion yuan. They are Vanke, Poly Real Estate, China Merchants Property, China Resource Land, China Overseas Land and Development, Longfor Group, Greenland Holdings, Xizhen Holdings, Sunac China, C&D International Investment Group, Greentown China. Furthermore, this year's sales of Chinese real estate have decreased significantly. According to the latest report from the CRIC Research Center, the top 100 real estate enterprises achieved a sale turnover of 312.2 billion yuan in April, a decrease of 12.9% month-on-month and 44.9% year-on-year. Cumulatively, the top 100 real estate enterprises achieved a sales turnover of about 109 billion yuan from January to April, a decrease of 46.8% year-on-year. According to the report, in April, a sale threshold for various tiers of the top 100 real estate enterprises have dropped to the lowest levels in the recent years. The sales turnover threshold for the top 100 real estate enterprises decreased by 47.7% to 1.85 billion yuan, or $260 million US. The sales turnover threshold for the top 10 real estate enterprises decreased by 57.3% to 25.9 billion yuan, or $3.6 billion US. Chinese real estate enterprises have been facing consecutive debt crises, leading to a downturn in the market. The Chinese government announced several new measures to support the real estate industry on May 17th. The notice stated that firstly, the nationwide minimum interest rate policy for commercial individual housing loans for first-time and second-time home buyers has been abolished. Secondly, The CCP's People's Bank of China and its provincial branches will guide the self-discipline mechanism for market interest rate pricing in accordance with the principle of adapting measures to local conditions. They will autonomously determine whether to set the minimum and maximum levels of any of the commercial individual housing loan interest rates for each city, based on the local market conditions and regulatory requirements. Thirdly, banking and financial institutions should reasonably determine the specific interest rate level for each loan. It should be based on factors such as the lower limit of interest rates determined by the self-discipline mechanism for market interest rate pricing at the provincial level, if any. It should be combined with the operating conditions of the institution and the risk status of the customers. The People's Bank of China announced that starting from May 18th, the interest rate for individual housing provident funds loans will be lowered by 0.25%. The interest rates for first-time individual housing fund loans for periods of less than 5 years, including 5 years and 5 years or more, will be adjusted to 2.35% and 2.85% respectively. For second-time individual housing provider fund loans for periods of less than 5 years, including 5 years and 5 years or more, the interest rate will be adjusted to not less than 2.775% and 3.325% respectively. At the same time, for resident families purchasing commercial housing through loans, the minimum down payment ratio for first-time home buyers applying for commercial individual housing loans is adjusted to not less than 15%, and for second-time home buyers, it is adjusted to not less than 25%. Meanwhile, Deputy Governor of the CCP's People's Bank of China, Tao Ling, announced during a routine policy briefing of the State Council on May 17th that a 300 billion yuan or $41.5 billion relending program for affordable housing will be established. This measure aims to encourage and guide financial institutions to support local state-owned enterprises in acquiring completed but unsold commercial housing at reasonable prices for use as an affordable housing for sale or rent, in accordance with market-oriented and rule of law principles. It is expected to stimulate bank loans amounting to 500 billion yuan. The Wall Street Journal states that this is the most daring move by the CCP government to date to rescue the real estate market. The aim is to end the real estate crisis that has been dragging down domestic economic growth for years, but the scale and funding source of the rescue plan are still unclear. The Wall Street Journal also points out that the core of the policy measures announced by the CCP on Friday is to support a policy that has been tested in some domestic cities. It would allow municipal and local governments to purchase unsold commercial housing and use it for affordable housing for middle and low-income families. By becoming the final buyers of millions of properties, the CCP government is attempting to rescue stalled construction projects, absorb existing housing stock, and persuade frightened buyers to re-enter the market. But the scale of this rescue plan and where municipal governments facing financial constraints will obtain the funds to purchase these properties remain unclear. Economists estimate that clearing a vast amount of vacant or unfinished properties scattered across China's vast land could cost hundreds of billions of US dollars. They argue that only the CCP central government or the People's Bank of China have the necessary resources to provide funds for a nationwide housing purchase plan. The report highlights the significant gamble taken by the CCP government. The widespread downturn in China's real estate sector is undermining investment and consumption, thereby dragging down overall economic growth. The latest data released on Friday indicates a slowdown in China's total retail sales of consumer goods in April, with nationwide real estate development investment dropping nearly 10% year-on-year in the first 4 months. Amidst dismal real estate data, the CCP government has been rolling out a series of measures to prop up the property market. A recent report by Bloomberg noted that the State Council of CCP is soliciting opinions from several provinces and government agencies in an attempt to push forward pilot projects aimed at clearing out excessive housing inventory. Additionally, reports from domestic sources reveal that Shenzhen has introduced a revised set of architectural design rules. Among other provisions, the new rules aim to reduce the shared space in residential properties. Previously, areas like refuge floors and machinery rooms were included in the shared space calculations, but the revised rules classify them as non-countable areas. Speaking to Radio Free Asia, Zhen Shongling, a commentator based in the US, conveyed the sentiments of many of his friends and acquaintances in China. They are feeling the immense pressure of high unemployment rates, wage cuts, and the bursting of real estate bubble, emphasizing that they are barely hanging on and the precarious state of private enterprises. Mr. Ren pointed out that China's economy has long relied on real estate sector to provide a significant influx of capital, which is then reinvested in infrastructure and the property market. But with the locomotive losing steam, it does not bode well for the Chinese economy. Director of New Economic Policy Research Center at Taiwan's Donghua University, Professor Shongxing Chen, stated that there is currently an oversupply of housing inventory in China, making it difficult to clear out the stock. For the general public, entering the housing market at this time may not only result in being trapped by high prices, but also face a risk of price declines. Without clear signs of reaching the bottom, people are likely to adopt a wait-and-see approach. There are currently no obvious indications that housing prices have bottomed out. Professor Chen believes that domestic consumption in China is weak, and the overall economic development policy overly emphasizes stimulating exports through manufacturing. But investigations by the United States Trade Representative and the European Union into China's export dumping issues make it difficult for China's export-led recovery to be sustainable. He remarked, with insufficient domestic demand and faltering exports, the three pillars of investment, including real estate infrastructure, remain weak. Over a dozen provincial finances are in crisis, with orders to temporarily halt infrastructure projects, which could lead to liquidity crisis or even bankruptcy. Therefore, it is a structural problem overall.